I've seen way too many investors making a very costly and common mistake focusing solely on value investing in order to generate the income required to support their desired lifestyle. This is a bad idea, and all the blogs, books, and YouTube videos on income investing tend to leave out why this is a bad idea. Hi, my name is Kobe, an associate with Noor Private Wealth. If you're new to my channel, we focus on helping our clients build wealth in the most tax efficient way. In today's video, I'm going to talk about why a total return approach to investing is far superior and much more reliable than the income investing style, and how a total return approach actually yields more dependable results. So let's jump right in. Now let's start first by understanding what is income investing. Income investing is building a portfolio that focuses solely on dividend-paying common stocks, preferred stocks, and bonds in an effort to generate sufficient income to maintain the desired lifestyle. Now, there is a common misconception out there saying that focusing solely on income investing is a better approach because building such a portfolio means you would never have to touch your principal, so you are completely protected from any market downturn and you will never run out of money. Now let's look at what proof do we have that makes dividend paying stocks better investment than non-dividend paying stocks. Believe it or not, dividends are not even one of the 5 factors that explains the majority of total stock returns. While dividends may seem like free money, the payment of dividends actually decreases the value of your stock. According to the dividend irrelevance theory created by Merton Miller and Frank Modigliani in 1961, it makes no difference to an investor whether the company they're invested in pays a dividend or not. Now, there is something that taxable investors should know though. On a pre-tax basis, it makes no difference whether your returns come from dividends or growth. But on an after-tax basis, the investor who has mainly dividends will be paying tax on them regardless if they're cashed in or not. This can be a huge setback for someone who doesn't actually need the funds at the time. Now, on the contrary, the investor who has mainly growth will be able to put off their tax liability by holding on to their shares. To sum it all up, if you don't need to cash in your shares, then don't. So why do so many people seem to prefer dividends if they aren't actually better investments? Well, 2 theories offered by Meir Statman and Hirsch Shafran in their 1984 white paper state that these people potentially have poor self-control to the point where they can't control their own spendings. So a cash flow approach ultimately creates a spending limit where they can only spend income and not capital. Their second theory is that people could be suffering from loss aversion, which simply means that if their stocks dropped in value, they'll likely feel uneasy selling just so they can spend it. Now, when it comes to dividends, approximately 60% of the US stocks and 40% of international stocks don't pay any at all. You end up reducing the diversity of your portfolio if you only invest in dividends, and disregarding good companies to invest in only because they don't pay dividends is not a smart move. Think about small cap stocks. An investment strategy that's solely income focused will eventually leave them out mainly because they don't pay dividends. Now, on the plus side, investing in Canadian businesses that do pay dividends can lead to a better tax incentives on your dividend income. Dividends are an integral part of investing, and dividend-paying common stocks are essential to a diverse portfolio. But being dividend-focused can cause tax inefficiencies for taxable investors, a lack of diversification in your portfolio, and a whole lot of loss of opportunities for great investment strategies. When you invest in a global diversified portfolio of total market funds, you're taking the total return approach. This method gives you a better tax efficiency, greater diversification, and the opportunity to expand on all the returns that the market has to offer. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let us know below, and the Senior Investment Advisor will get back to you. Thank you very much for watching, and I will see you next time.